Mechanisms that discipline financial reporting quality. Question 3. An investor reads an independent auditor's report that provides an unqualified, clean opinion on a company's financial statements. The investor should interpret this opinion as providing reasonable assurance that the financial statements A. Are completely free from any material fraud. B. Contain no errors in the underlying accounting records. C. Present the company's financial position and results fairly in all material respects. Correct answer, C. An unqualified opinion means financial statements comply with accounting standards and fairly represent the company's financial position. Material respects means misstatements are not significant enough to influence economic decisions. Audits provide reasonable assurance, not absolute guarantees, using sampling and testing procedures. Auditors assess risks but cannot guarantee the absence of fraud or errors. Unqualified opinion indicates reliable financial statements, but not risk elimination. Investors should read footnotes, consider non-financial factors, and understand audit limitations. A. Incorrect. Audits focus on material misstatements, not all fraud, and some fraud types are hard to detect. An unqualified opinion means no material fraud risk, not zero fraud risk. B. Incorrect. Audits use sampling and analytical procedures, not full verification, to determine material errors or fraud. Auditors issue opinions based on materiality of accounting errors. Question 2. A primary limitation of using debt covenants to ensure high-quality financial reporting is that they A. Are not legally enforceable documents. B. Can create an incentive for earnings management. C. Rely on financial metrics that are not defined in the loan agreement. Thumbs up and subscribe this channel. Correct answer, B. Debt covenants are like a safety net for lenders, designed to keep them safe by making sure borrowers are financially sound. These covenants usually have two main types: maintenance covenants, which are ongoing rules, and incurrence covenants, which put limits on taking on new debt. They're often based on financial ratios, like debt to EBITDA, interest coverage, or the current ratio. Managers are really keen to avoid breaking these covenants because if they do, it could mean defaulting on the loan, paying higher interest rates, or having the loan accelerated. This can create a lot of pressure to tweak financial figures to make sure everything stays in line. Here are some sneaky ways covenants might encourage people to bend the rules. 1. Fudging numbers at the end of the period to hit those ratio targets. 2. Rushing to recognize revenue before the covenant's measurement dates. 3. Postponing expenses until after the most important reporting times. 4. Using overly optimistic estimates to boost earnings. 5. Choosing which items to include in the financial statements to make covenant-related numbers look better. A. Incorrect. Debt covenants are legally enforceable, and breaching them constitutes default. C. Incorrect. Loan agreements precisely define covenant metrics, including debt to EBITDA thresholds, interest coverage ratios, and current ratio requirements. Covenants can lead to short-term decision-making, encourage conservative accounting, restrict operational flexibility, and encourage covenant management through manipulation. Question 1. A country's securities regulator has its budget and staff significantly reduced. This development is most likely to A. Decrease the opportunity for companies to issue biased financial reports. B. Have no material effect on the quality of financial reporting in the country. C. Increase the opportunity for companies to issue low-quality financial reports. Correct answer, C. Regulators are like the guardians of securities laws, making sure everything is in order by checking on filings and looking into any shady behavior. Their watchful eye helps keep companies from trying to trick people with sneaky accounting or pulling off fraud. To keep things in check, they have some pretty strong tools up their sleeves, like fines, penalties, and even going after people in court. But with fewer funds and staff, it's a bit tougher for them to keep up the good work. When there aren't enough resources, it can mean less frequent or detailed checks of financial statements. This can lead to delays in looking into any possible violations, making it harder to catch and correct misreporting. As regulators have less power to keep an eye on things, companies might not face as many repercussions for not reporting correctly. A. Incorrect. Reduced oversight weakens checks on aggressive accounting. B. Incorrect. Weaker regulatory capacity leads to lower reporting quality, increased earnings management, and higher rates of accounting scandals. This can erode investor confidence and raise capital costs.